Hello and welcome. You have tuned into Buy Now, Sell Now on ET Now. I'm Shrishti Sharma and with me as always is Cheryl D'Souza. And viewers, this is the show where you get answers for all your stock related queries. In a short while from now, we will connect with our experts. And looking at the market fall today, we believe that there might be many queries trickling in today, Cheryl. But indeed, looking at the Indian markets right now, I actually feel good despite the fact that if we look at the global market sell-off and especially the Asia market, they are hitting the lower circuits now.
Absolutely. A very good morning to you, Shrishti. Not a good morning coming in for global markets, India included, because over the last 15 minutes or so, we've only the fall has only accelerated when you talk about the Indian markets. We've seen a sharp downtick from the word go. We did see a mild bit of correction, hoping that correction would be able to sustain correction, as in we saw a mild bit of recovery from the day's lowest point, and we were hoping that we will be able to sustain that, but that's not the way how it's transpired. 2.5% downtick coming in for the Indian markets. You have a deep global sell-off that is underway at this point in time. Flashing on the bottom of your screen, you can see what is Nikkei doing. 11% downtick coming in for Nikkei. You have Kospi that's down about 8%, and there has been non-stop circuit breaker coming in for the topics or for the Kosdaq, that is Kospi's index as well. But let me just quickly recap what's happening globally, because most of it is actually what's happening in the global markets than what is happening back home, because you have the global fears that are trickling in here. So you have Japan's Topics Index that's fallen as much as 10.6%. This is a decline that would be the worst day since 1987, and that's actually a bigger drop than 2011 nuclear crisis. You have MSCI Asia Pacific Index that's entered into a correction. Apart from that, you have yen that is rallying, and it has actually, the rally has gained steam through the day, with the currency now up more than 2%. It's gone up to the levels of 143 to the dollar, and this as investors are preparing for Bank of Japan's hikes as well as Federal Reserve's cut, and that you will keep hearing through the day. The yen carry trade, that's the one that is actually impacting the markets today. Not just the currency market or commodity markets that are reacting, you also have the cryptocurrency market that's reacting. So you have Bitcoin that's slumped about 10%. This is on back of the souring investor sentiment. Tech stocks also looks like they are vulnerable, because you have Nasdaq index futures that are down in excess of about 3.5% right now. You have S&P 500 futures also that's down about 1.8%. Not a great picture coming in for the markets at this point in time, Shrishti, and that's reflective of what exactly is happening back home as well, because we are now touching day's lowest point. We are 2.7% downtick coming in for Nifty, testing that 24,000 mark.
Certainly, Cheryl, important support levels being tested by the benchmark indices, and look at the fall in Nifty Bank as well, almost 1,400 points down right now, and even the broader markets are not supportive. It's just the FMCG and a couple of pharma counters that are still holding on to some mild gain. But with this, viewers, let's move on and let's shift focus to the earnings then. And there are a lot of earnings that are trickling in. And Sheela Foam is the company that we're going to be focusing on. The company posted a good set, but that's on the back of a lower base. But what is the outlook going ahead? Let's understand more from Mr. Rahul Gautam, who is the Executive Chairman of Sheela Foam, joining us right now. A very good morning, Mr. Rahul, and thank you so much for your time. First of all, just wanted to understand more on the numbers then, because the company has managed to see a strong growth on a YOY basis, but believe that that's on a back of a low base. One, what's the demand trend that you see going ahead? And the second part of the question is, will the company sustain this strong growth of 25% for FY25 as well? Is this growth number sustainable?
So let me begin with the quarter one of FY25. And I would just say, this is reflective of the typical integration blues that we are experiencing from the acquisition made of Kurlon in October last year, and we have chosen to hasten up the whole process, rather than, let's say, going the Air India Vistara way, which is spread it out over a couple of years. We just wanted to finish all that up in 6 months, and that has created a bit of a disruption. But I just want to say that all that is behind us, and in fact, so the ERPs are integrated, the factories are integrated, back-end completely integrated. It's the front end which has taken a bit of time and effort, but now it is settling down, and what we should see as we go forward is is improvement, all-round improvement, whether on the bottom line or on the top line. The question that you had, whether 25% is sustainable, I would say that it should be closer to. I mean, as far as if I take the full year, which is coming up, the FY25, it should be between 15 and 20% growth that we should see.
Good morning, Mr. Gautam. This is Cheryl also joining in the conversation. And now, despite we've seen a stable raw material prices, we've seen the margins actually seeing some sort of a contraction. If you could let us know what exactly led to the decline in the margins of the quarter gone by?
So as far as the raw materials are concerned, they are low and steady at the moment. I expect a little bit of a drop only, but I think they are at a low level. We don't expect anything happening before quarter three or the year end. The margin part of it, actually, if you look at the numbers, there is a marginal improvement in the margins for the Indian operations, and it's marginal, very small, but that's reflective of the synergies of the integration process that has been there.
Also, Mr. Rahul, wanted to understand what is the outlook on the EBITDA margin front? Is the company looking forward to get back to the double-digit EBITDA margin in this year itself or from Q2 itself?
It should be, I mean, if you look at the EBITDA margins, it should be anything of the order of about 12%.
Right. So your combined market share of about 29%, and the company expects a sizable increase. So if you could quantify to us, what is the sizable increase that you are expecting, and also what's the internal target that you all have set for FY26 or so?
So that's exactly the number that we should really be looking at, which is close to 30%. I mean, Q1 is not a reflection of that. Q1 is just a reflection of quickening up the process of integration, and therefore things, kicking up a lot of dust, which just needs to kind of settle down, and which has. But the market share would be of the order of 29-30%.
And lastly, Mr. Rahul, if you can help us highlight the demand trends in the export as well, and especially for Spain and the Australian market.
So nothing for the export side. That has definitely gone through a complete sea change. US was the main country which was importing from all over the world, including India, and they have just levied huge amounts of anti-dumping duties. Doesn't make any sense at the moment to go. And then this little bit of a disruption on the Suez Canal, where the freights have gone up because of that. So I don't see anything much happening on the export side. As far as our operations in Australia and Spain are concerned, they are both going through a little bit of a different dynamics. Spain, raw material prices are down, so it appears that the top line is down, but the quantum growth has been of the order of 12 to 13%, and that will continue to grow because we are a very small part of that large market. As far as Australia is concerned, it's a mature market. It's not a growing market. It's, I mean, you would see similar kind of levels. If there are any changes, it's only on account of raw material prices going down, and therefore the top line going down.
Right. Thank you so much, Mr. Gautam, for joining us in the show to talk about the quarter gone by for Sheela Foams and what you're expecting going ahead. Thank you so much for joining us on ET now. And let's put the spotlight then on markets. You can't take your eyes off what is exactly happening in the global markets. 12% downtick is what you're seeing in Nikkei index. India volatility index, as you can see it on your screen, a sharp spike, 52% spike coming in the India VIX, and that is most since August 2015 as per the data that we've just received. If you talk about the level of the India VIX, then it is at a highest level in about 2 months or so. Let's talk about the Japanese VIX, because you will be astonished if you look at the number in Japanese. Nikkei 225 volatility index, it surged about 132% 1%. It's a record one-day jump coming in for Japanese VIX as well. So looks like that sort of a trend of a surge in the VIX is actually trickling in the rest of the globe. And Kunal is here to help us understand or make us understand what does this exactly mean. Kunal, did you wake up this morning hoping that it will be deep red across the globe?
Well, I think practically yes, we assume that it will be red for the indices because of the way the global hangover was, especially on Friday, the news flow across the globe on the weekends. So we expected that the markets would be a bit red, but then I think the data point is a bit now getting a bit more aggravated, where you see the VIX on the global indices. I think if I'm not wrong, the topics market for Japan. I think that's that's a the small cap index for the Japanese market. That's also I think hit much lower levels. So yeah, I think it's a sell-off which is now starting to maybe hit those pain points for many global investors. So far, I think we are still doing relatively okay. Now, I'm not talking of it from an intraday perspective, but I'm talking of it on a relative perspective. On a YTD basis for our markets, I think we're still up some 10% odd for our markets on a YTD basis as compared to many of the global markets which have retraced their entire 2024 gain. So I think it's a matter of volatility settling down. It may not be a one day, 2 day phenomena that we may expect the volatility to settle down immediately. But in case if it happens, say in the next 5 days or in the next 1 or 2 weeks, that also could be a good sign that our markets could also stabilize and the sell-off could probably not get a lot more aggravated.
Let's see and let's hope for that to happen. But indeed, for today, it's a bloodbath on the D Street that we are seeing across. But with this, viewers, it's time to slip into a very short break. Don't go anywhere. We'll come right back after this quick break.
Welcome back. You're watching Buy Now, Sell Now on ET Now. And briefly, we have the Nifty that slipped below that 24,000 mark right now, making a very mild bit of recovery, but that's hopefully we have to see if it's sustainable or no. 24,023 is where the Nifty is at currently. You have a sharp bloodbath, or not sharp bloodbath, you have bloodbath across the global screen when you talk about Kospi, Nikkei. Also, you have the Taiwan index also that's seen a sharp downtick of about 8% on an intraday basis. The VIX is spiking globally. Talking about the India VIX has seen a spike of about 50%, taking the level to the highest level in about 2 months or so. But let's try and address all the stock related queries that are already pouring in. We have Kunal Bothra on the technicals to take all of your queries, while on the fundamentals we have Sonam Srivastava joining us on the show. Very good morning to both of you, and let me quickly kickstart with taking all of the queries then. This one is coming in from Hamza, who's writing to us from Madurai, wants to know about KRBL. She's bought it at an average price of around 236 rupees per share, about 870 shares of this one. Can she buy some more at current price? She's a long-term investor. Kunal?
Well, the stock was as it is underperforming. I think if I'm not wrong, it had managed to break below its key averages when it was at 385, 390, start of 2024, end of 2023. And from there on, the stock has been making a pattern of lower highs and lower lows. So I'm not sure of what is transparent to the stock in terms of news flow, but it still looks negative. I would not suggest to average the stock at current levels, but in case if it comes back to say 310, 320 mark, which could be very close to the previous resistance, that could be a point where you may even look to exit.
All right, moving on to the next query. And Sonam, this query is from Kaushik Mitra from Mumbai, and he wants a view on Jio Financial. Can he go ahead and enter afresh in this one, or rather swap his investments in IRCTC, because in IRCTC he's still at some mild profits? What will be your advice in both of these?
So Jio Financial, definitely see after the results, we saw very good results coming out of the stock, but not a lot of movement. I think the stock has been consolidating for a while, and I think we have slightly more attractive plays in the NBFC segment that he can look at. IRCTC again, it is in the railway defense segment where the returns have been very strong, but there has been some consolidation for a while. I would say you should hold on to it given the volatility to step into this slightly overvalued segment.
Let me take this next query then, and this one is coming in from Venkatesh, writing to us from Indonesia. He wants to know about 3 stock recommendations for a period of 2 years. from you, Kunal. What are the stocks that are looking attractive right now? We are seeing sharp decline in the markets. Now, actually, we are actually comfortably below the 24,000 mark for the Nifty.
Well, yeah, and I think it would make a lot of sense to try and just wait out for the volatility to settle down, because what could happen is that in every phase of correction, the markets determine a certain set of sectors and stocks which could get into a corrective phase, and those sectors, those stocks, they would tend to underperform. What we typically say, the heroes of the previous uptrend or a bull trend, they could probably reverse, they could probably get into a zone of underperformance. So I think rather than looking at this retrospectively, it makes a lot of sense to wait for this volatility to settle down. But whenever that happens, I would probably believe the likes of, for example, HDFC Bank, if in case the stock settles down to say 1550, 1600 range, that could be a good zone to try and chip into this stock. You might look out for ITC, I think closer to 460, 475. That could be a very good range to buy these stocks. So focus on large cap names, but then as I said, maybe just wait out for this phase of volatility to settle down if you're looking at this for the next 1 to 2 years at least.
All right, but since you're talking about ITC, Kunal, the next query is from Nikhil Sharma, and he says that he's an intraday trader and wants to know that will there be intraday opportunities in ITC, and he also wants advice on ITPI. He's already holding the shares price close to 106 rupees. What's your take on this one as well?
I think ITC, I'm not sure on an intraday basis whether you might see any kind of a great opportunity, at least at this kind of a market. In case if, say, in the next hour or so, if the markets stabilize and you might see some recovery or the Nifty coming back to 24,050, 24,100 mark, then there could be a point where ITC may come back towards 490, 492 levels on an intraday basis. Now, onto IDBI Bank, I think it's a very good time to try and book profits over here, or at least major part of your profits, because the stock is now starting to get into a mild reversal. The volumes which are transpired for IDBI Bank on the upside, the volume patterns and the indicators now are on the verge of a mild corrective phase. So if you can look to exit the stock at current levels, look to buy back in case if it drifts down towards 85 to 90 odd zone.
All right, let's take the next query then, and this one is coming in from Hitesh. He wants to know about Godrej Properties. He's already booked some profits at around 3,100 rupees per share. He still has about some shares in his portfolio. Kunal, is it a good levels now to go ahead and enter Godrej Properties, is what he wants to know.
No, as I said, that I think maybe better levels could be seen into the stock. It's just fallen below the 50-day moving average yesterday, and from there the stock at I think 3,070 has already fallen by a margin of 5% more. But I believe that as I said, that maybe if the markets correct a bit more, you might probably see the stock heading towards 2750, 2700 also. So maybe wait out for another 5% correction off, and as I said, I think the bigger overlays, if the markets start to stabilize, that could be a point where you may look to go for a contra buy.
All right, the next query, Sonam, is coming from Rohit from Pune, and he's holding Tata Steel. He actually entered Tata Steel just last week at a price of 161 rupees, and since he's at a loss in this one, what's the outlook? Since overall across we are seeing that the global markets as well as the commodity market is seen to be under pressure, but what's your take on Tata Steel? Good to hold on or look out for better opportunities?
No, definitely. I think, like you said, commodities have been under pressure and the metal names have been consolidating for a while. So probably not the best time to buy Tata Steel was not last week, but yeah, I think we are expecting rates to come down sometime soon. Even though right now the situation looks a little bit risky due to the Japan news, but if the rates cut down, then you could see an upsurge in commodity prices. So if you bought it at those levels, you could hold on, but you have to be very cautious about the movement in the global markets.
Right, be cautious also when you talk about the momentum in the global markets. Now our Indian markets are down over 3% right now as we speak, 3.3% actually to be very precise. That's the downtick coming in on Sensex. Broader markets seeing sharper carnage, but we will continue the coverage on the other side. Also take a stock related query, viewers, so don't go anywhere.
Welcome back to Buy Now, Sell Now, and that's the market volatility that continues because just a while back we did slip below that 24,000 mark, but a decent recovery, almost 100 and 150 points of recovery, that what we are seeing on Nifty 50 as well as for the banking index as well. So let's see that whether we build on to some bit of a recovery or not. But without further ado, let's get back to your stock related queries. And the next query that I have, Kunal, is specifically for you. This one is from Anusha from Karnataka, and I would like to know from Kunal sir his view on which sectors or stocks should we look to invest in this market correction. Kunal, what's your take?
See, I think first and foremost is, there would be specific set of defensive names which would start to at least outperform over the very near term. So let's look at the scenario where, in case of the market volatility continues across the globe, so even for the next 1 week or so, I think in that aspect, maybe the pharma index, insurance sector relatively, the FMCG names, they could start to at least shield or show signs of relative outperformance with respect to the benchmark indices. But I also strongly believe that whenever the volatility settles down, that could be a very good point where potentially these banking names, the financial services sectors, I think many of the sectors would start to open up as very good risk reward play. So I think what matters now is a two-part phase. As I said, in the first phase of volatility, it makes sense to try and protect your portfolio in terms of defensive names. But once the market stabilizes, that could be a very good time to try and latch on to those aggressive sectors or the high beta spaces.
All right, on your screen, as you can see, the US futures, very grim picture coming in on that particular front. You have the NASDAQ futures that's down about 6%. Now it's down about 5.5% or so. You have S&P 500 futures down 3%, Dow down about 500 odd points. Not a great picture coming in for the US futures, nor is it a good picture coming in for the UK futures as well, because there also you're seeing a sharp decline. Now Nifty down about 3% once again after we've seen that sort of a rebound from the lows. But let me take this one coming in from Sunny. He's writing to us from Goa and he wants to know about Swiss military consumer goods. Kunal, I don't know if you tracked this one by any chance. 3,000 shares at a price of 25 rupees per share.
Not really, I don't track it.
All right, so I'll give that one a skip. This one is coming in from Vijay. He's writing to us from Chennai and he wants to know about some good Nifty 50 stocks which you think, Kunal, is the right one to accumulate right now, given the fact that we've seen a downtick in the markets, or do you think that there is some more downtick expected, so hold on to that strategy?
See, I think the answer to that, of course, would depend on if the global markets they tend to recover, because what happens, at least as part of the experience, what I've seen is that whenever the global markets tend to be a bit more aggressive on the downside prior to the opening, we see that the performance during the day is a lot more better. So I think in that aspect, maybe over the next couple of days, we might see the volatility settling down pretty quickly for global markets. In terms of large cap names, and I think it's a good sign that you are focusing on large cap stocks. I would still believe that stocks which are relatively low to moderate beta and the ones which have formidable price trajectory, I think they are the ones which could be bought into. Mentioned few names earlier also. The likes of HDFC Bank looks attractive. ITC, something which I believe closer to that 475 mark, could probably be a attractive proposition to look out for.
All right, Sonam, coming to you for the next query. This one is from Bala from Chennai, and he wants to know which amongst CDSL or CAMS is a better buy right now, and any entry levels that you can help him with. That would you suggest to enter afresh at current levels, or would you suggest to wait out for some more dips and then enter maybe?
I think both of these names are extremely interesting, and we've seen big moves happening across the board for both these stocks. I think the whole theme of capital markets and securities has been very strong. We've seen very good numbers come out as well, I think, from this segment. So I would say that both of them are quite interesting. Even like Kunal said, when the market consolidates, that would be a good time to jump into either of these stocks, I would assume. So he can have a pick between the two, right?
That's the fundamental take. But Kunal, if one has to choose between CDSL or CAMS, which amongst them would you prefer right now?
See, I think I'll always go for charts which are more consistent and relatively low to moderate beta So I think in that aspect, just looking at it relatively, as I said, CDSL seems to be a better chart because of the lesser amount of extent of volatility for the stock price as compared to the high movements. Of course, both of them have done reasonably well for themselves over the last 3 to 4 years. But I think CDSL could be something which I would probably prefer or give it a slight edge. And in case if the stock dips down back again to its 50-day moving average, which is at 22.25, 22.27 on current levels. So maybe 20 to 50 could be a good price point. In case if it happens for CDSL, you may start to look to buy on dips for the stock.
All right, so that's about CDSL. We've been only able to take 11 queries today, given the fact that the market fall is accelerating not only back home but also globally. The picture there is pretty bleak, with Nikkei actually closing with a record daily point fall. That fall has actually exceeded the drop marked on a Black Monday in October 1987. 4,450 is the downtick coming in for Nikkei, and the market has shut shop down about 12.4%. Thank you, Sonam, as well as Kunal, for joining us on the show. On the other side of the break, we will decode what exactly is happening globally, why such a carnage coming in the global markets, and what should you be wary of. So don't go anywhere, viewers. Welcome back. You're watching Buy Now Sell on ET Now, and it's looking pretty grim when it comes to the global picture. You have US futures that are seeing a sharp downtick. In fact, you have also Apple stock that's actually seen a downtick of about 10.8%. That's the Apple Frankfurt listed stock that's seeing a downtick, because you have Warren Buffett, who's actually cut stake in Apple. But not just that, you had the Japan market actually see a downtick of about 12%, intraday 13%. Topics is down, Kospi is down and out. US futures are down and out. And what do we make of this global sell-off coming in? We have Nikunj Dalmia also joining in. And Nikunj, everyone is trying to understand what exactly has happened over the weekend. There are multiple factors impacting the markets right now, isn't it? There's not just one thing that you can watch out for.
Even I'm surprised with the brutality of the fall. I mean, everybody, I'm sure, is surprised with the brutality of this kind of a fall, because frankly, there's nothing that scary which has changed over the weekend. At least that's my limited understanding. It's a risk-on moment which is getting multiplied by what is happening in Middle East. Yen carry trade is reversing. Buffett's exited out of Apple. And then there is fear of a recession. The same market had ignored all fear of recession. The same market had ignored when yields went to 4.4%. The same market had ignored when there was a real fight-like in situation, or when geopolitical tensions actually happened in the Middle East. So I think it's the weight of the market which equity as an asset class, I think, is now finding it difficult to digest. I always say that markets, they rally because of micros, and they start reversing because of macros. And I don't think macros have changed that much that you can say the bull market in a sense has ended. Charu Chanan joins us, global strategist, head of fixed. He's not there? Oh, Charu's there and Manpreet, they both are there. All right. Charu and Manpreet, good to have both of you. Thank you for joining us. Manpreet, what has changed in the last 48 hours that it appears like a sell-off we've seen in and around COVID crisis, or what we've seen in 2008? I mean, the screen smacks of bloodbath, while the news is not that bad.
No, I agree with you. I think we need to separate the short-term volatility from the big picture fundamental, right? In my view, there are two factors that are driving this. On the fundamental side, the concern obviously started in the US after we had the release of much weaker than expected job market data, because that really caused a little bit of a reassessment, of the soft landing thesis, or whether downside risk to growth were greater than what the market was pricing. And I think that helped explain particularly what we saw on US yields. But when you think about the second factor, I think is really what we're seeing in Japan, because we had the Bank of Japan going the opposite direction. And from the Japanese yen, the extent of strength we've seen, I mean, the yen is up well over 10% just within this month. And I think that helps explain a lot of volatility we're seeing in equity markets around the world, particularly with the US tech, because we know that's being a big source of global liquidity, of the carry trade, so to speak. And I think that in the near term seems to explain a lot of what we're seeing on the equity side, much more so, rather than, like you said, a big sort of reassessment of fundamentals. I think what we really need to see is the dust settle a little bit on the position unwind, the excessive positioning unwinding in the Japanese yen, in US tech, before we start sort of taking a fresher look at whether fundamentals have changed or indeed we're still in the same place.
Okay. Charu, what is your sense? What is calling this selling?
No, absolutely. I agree with what both of you just said. Nikunj, it's been a dramatic shift in sentiment caused by, of course, that one jobs report out of the US on Friday, but coming at a very critical time when, like Manpreet also said, we've had some signs of the carry trade unwinding because of a hawkish pivot from the Bank of Japan last week. And along with that, there have been these other smaller drivers, I would say, something like Warren Buffett taking down some of his positions. There's been some amount of disappointment around tech earnings as well, particularly what happened with Amazon last week, and very, very importantly, what happened with Intel as well. So there have been some big drawdowns there that has obviously hurt the sentiment as well. But overall, I mean, I certainly think that this is kind of an overreaction to one jobs report. You can't go from worrying about elevated inflation to worrying about a dramatic recession in 1 week. So I think certainly there's going to be a reality check. There's a lot more important US data coming out, particularly today, the ISM services number, and then, yeah, going on in the week as well, which will give us a reality check on really how bad is the US economy faring and whether we should really be expecting the Federal Reserve to cut rates by 50 basis points in just one meeting in September, or over 100 basis points through to the end of the year.
Charu, if this is a sell-off which is largely because of technical factors and this is not a macro event, do you think this will be remembered as a bull market correction that by the time it hits you and by the time you realize it will be over?
Yeah, it could be very well be that, right? I mean, an August sell-off or a correction, because we already know that US equity markets have traded to very high valuation levels. There's been huge amount of concentration risks, which we've continued to, warrant the fact that that needs a correction, really. And, obviously taking some of that risk off the table after climbing to such highs, it deserves the correction, right? And it could, in the end, prove to be a healthier correction. But we really need to watch how the US economy fares. I mean, it has been a bit of a two-lane economy, I would say, where some parts of the economy continue to be resilient, but there are other sectors that are getting hurt because of those high interest rates. And there's no denying the fact that the US labor market is loosening. But again, I would emphasize, coming from a point where we've been calling that the US labor market is loosening at a very measured pace, to today suddenly saying that the SAM rule has been triggered, and this is a very key recession indicator, and we need to brace ourselves for something worse. I think that looks a little bit premature at this stage.
I can understand that there is a sharp sell-off in leverage. There is a sharp reversal which is happening in currency or commodities, but the selling is very unique and very widespread. Gold is down, Bitcoin is down, currencies are down, 10-year paper is down, everything is down.
And look, maybe on that point, I can jump in a little bit, right? Because I think the linkage here is quite important. You're right, a lot of things are down, but if you think about what's down, the theme is quite consistent. It's been the popular trades, which is US technology, obviously cryptocurrencies fitting into that, and a lot of these link back to yen funded trades, which in every cycle we know, at least the last few cycles, that's been a big source of leverage. But I think here's where a little bit of hindsight almost is helpful. I was looking at what we'd published ourselves just a couple of days before the sell-off on Friday, and what was causing us the most concern going into last week was positioning. And that was excessive positioning in the yen, excessive positioning in US markets, particularly the tech sector. And I think with that benefit of hindsight, which is always nice to look at after the fact, that's where we've seen a lot of the pullback, the current sell-off being concentrated. If I look at US sectors more broadly, though, I think within sectors you're seeing quite a bit of dispersion. So I think that's one factor that argues that this sell-off is quite linked to that carry trade area. The second is, even if you look at the extent to which the VIX has jumped, the extent to which the dollar's weakened, we are so far within ranges we've been in the last 12 to 18 months. So there are rises in volatility, but not at the scale of recessionary sell-offs. So that's why I think, just I suppose I'm agreeing with Charu to a large extent that, look, what we seem to be experiencing at the moment seems to be more positioning led and unwind what was very excessive positioning. And these are hard to time when exactly they'll bottom. We can look at technical levels, but momentum is quite strong. What's important is once the dust settles, to get a handle on, US labor market weakness for us is really the big fundamental risk. Perhaps we haven't weakened, quite as much as markets are fearing, but that's to me the key one to keep an eye on from a fundamental perspective. What's happening right now seems more positioning led.
Okay. Charu, today it's looking like a sell-off. Soon when asset deflation starts, it may look bad, and then it will start having impact on the way how currency, carry trades, a lot of interconnected things would move. What are the chances that what looks like a spark right now, it could just be a beginning of a difficult fire, so to speak?
No, I mean, I would agree there might be room for this unwinding to run because, again, the key point here being what Manpreet just said, because we've had massive skewed positioning in these trades. But when I speak from a structural lens, Nikunj, you talk about inflation from a structural perspective, you still have a US economy that continues to and will continue to spend massively. You still have a green transformation that continues to call for a higher structural inflation. You still have risks of trade tariffs playing a part there. So a lot of factors really pointing to the fact that to expect inflation to come back down to 2% looks like a little bit of a stretch at this point. And when you say that, then it also gives you some sense of where yields will go. Can yields really go back to the lows that we've been used to seeing just before this latest hiking cycle? And if you think that is not going to be the case, then to me, very much it sounds like the fact that these yield differentials are here to stay for quite a substantial period of time. If the US yields are going to be above 2.5-3% or so, the Bank of Japan can do only as much in closing that yield gap that it has to the US yields with its small paced rate hikes, even a 15 basis points rate hike, what it's doing to the Japanese stock markets, it's pretty evident at this point, and how far they can go from here remains a big question to me. So in a sense, I mean, of course, volatility, I think that is the key driver here. And if we see volatility staying low, then I don't see why carry trades will be unwound in a massive, massive manner here.
Charu, where does India fit in? We've fallen the least. We're the best story right now. Do you think in this entire global carnage, India will fall, but it will fall the least?
So if you talk from an FX lens, I certainly see that the INR is getting hurt today because that is, again, one of the favorite target for carry, especially in Asia, and especially after the elections have been over. INR has been pretty stable, and that obviously gives it room to be a favorite destination for carry trades, which, again, like I said, right, there could be some risk of an unwound, tactically speaking, in that space. But from an equity lens, certainly India looks like a safe haven in this space. The only headwind that India could face is how much China can provide stimulus, a demand-based stimulus, because that's where they're shifting their focus to, from supply-side reforms to demand side stimulus announcements. And if that kind of really picks up from here, we see Trump trades unwounding as well, and the potential of Kamala Harris coming through as the next US president. We could have some flows diverted to China, which is far more undervalued compared to India at this point. But again, structurally speaking, India looks like a better safe haven in this whole global rout that we are facing right now.
All right, Charu and Manpreet, thank you very much. It's a day when you just want to sit back and say, I will do nothing, because you never put money on the first fall. And I'd just like to remind our viewers that last two local events, if you bought the fall, it's been a rewarding experience, which is that, let's say you bought the market on the day when markets fell on the election day, or you bought the markets on the day when elections fell on the budget day. When the news was not something what markets were expecting and you bought the fall, you were handsomely rewarded. But this market, when I say this market, Indian markets were due for a correction. Correction comes and knocks you, you don't know when and how. But what do? Do you go out and buy, well, you don't go and buy this first correction because this is a global correction. And typically when the global correction of this magnitude comes, it's not going to settle down in a day or so. And rather than being a compulsive buyer on decline, I would say it's better for the trend to settle down rather than just jumping on the first flash, because recency bias is something which we all suffer with, and the recency bias of what happened on the election day, 5th of July, what happened 5th of June, what happened to the market on 23rd of July on the budget day when you bought the market fall, I think is something which tends to have an impact on India. But you were due for a fall, global markets were due for a fall. When it hurts, when it hits, it will hurt you. And today I think a lot of portfolio repositioning will happen. The VIX has gone up 50%, and typically when VIX goes up in such an elevated manner, those are not the times when you buy. You buy something when there is either outright value, or there is sign of a reversal, or there is reasonable amount of conviction. Now, where do I have reasonable amount of conviction? Here's where I have reasonable amount of conviction, Cheryl. My reasonable amount of conviction is coming from the fact that Indian corporates are not leveraged. So even if interest rates and carry trades reverse, it's not going to have an asset shock like 2008 when corporates were leveraged. That's the first thing you need to look at, a global sell-off. Second, the macros in India are getting better. Interest rates are coming down. And the positioning of the bond market is also such that I don't think there is a problem in terms of a macro reversal. Third, there is a lot of support which is coming from SIP investors. They're not going to go away in a hurry. Fourth, we are still in an economy which is growing. The risk is valuation, risk is not growth. This kind of an asset sell-off, I think this is more like unwinding rather than event based. Typically markets, they peak out when there is event or when there is a huge risk of valuations. So this extraordinary run up, I think in equity as an asset class is getting checked. We will get hit, but if others are getting hit, we will get scratched. That's my limited.
That's exactly the way how the markets are looking like at this point in time. Thank you so much, Nikunj, for joining us on the show as well, for giving us your take to explaining it to our viewers, and also breaking it down for our viewers as to what should you do in this sort of a fall right now. Just hold tight, sit tight, don't do anything. This is just could be one of the early signs of a correction in the global markets. For now, you have Nifty that is trying to hold on to that 24,000 mark. On that note, thank you so much for watching. It's a goodbye from me, Cheryl D'Souza, and the team that put the show together.